highs within just 3 to 4 months. The markets are actually down by 12%. This is the first meaningful correction that they've seen, and I tell you that over the last 10 years, India has legit been a star performer. Will this continue? And I think the unanimous answer would be that it would be better. And let's not just, China is in a place where they're actually facing a aging population, more than $5 billion. India stands fourth in the world on this metric. Overall weightage of India increasing in the MSCI index, whether it is the world index or emerging markets index, good time to also reassess how you're playing the markets and reassess your strategy. Hello and welcome to Rupeeting. I'm Sagar Lele, the founder of Rupeeting, and today we're here to talk about the Indian markets. Everybody seems very worried about what's happening in the markets right now. From their highs within just 3 to 4 months, the markets are actually down by 12%. And that's just Nifty 50. And mid and small caps are down even further. And that's caused a lot of worry amongst investors. We clearly see a lot of fear lingering amongst investors, especially the new investors who've joined in post-COVID and seen a unidirectional rise in the markets. We see a lot of outflows, at least from the lower ticket size products that we've got. And despite urging investors to stick around and not really worry about this fall, there seems to be a certain level of fright that's gripping onto the markets, which hasn't been seen before, at least in the last 3 years. Especially also because India has seen an unprecedented growth in terms of how the stock market returns have been over the last 3 years. So anybody who's joined the markets new, this is the first meaningful correction that they've seen, and it's obvious that that will cause some worry and spook in their minds. But we're here to sort that out. We're here to give you some context, help you figure out how to think about the markets, how to build conviction, how to set your eyes straight or vision straight in terms of what you're investing for, and how to strategize your investments and align yourself with what's happening in the markets right now. To explain this to you, we're using our stories framework, which we highlighted to you last time, where we find meaningful narratives and convert them into wealth creation opportunities. So our proprietary framework also helps us think about the markets overall as well, and not just in terms of picking out stocks. And because we're doing this exercise and revolving it around our investment framework, what we thought is, let's twist this a little and take this in a very typical story format, which is every single story has a character, then that plot is set, every story requires a hero, there is necessarily a problem in every story which the hero solves, and then comes out victorious out of that problem. That's the storyboard for every single book, every single movie, every single play, and that's how it pretty much works in investing as well. So we're gonna extrapolate the same storytelling and to the Indian markets this time around. But to set the stage first, let's introduce the character, which is India, and tell you that over the last 10 years, India has legit been a star performer. You've seen India be the highest growing economy over the last 10 years, surpassing most global economies, including the very bright performing USA and including China as well. Over the last many years before this time period that we're talking about, people had their doubts about India ever being able to sustainably pass the Chinese in terms of growth rates. But over the last 10 years, this has been proved wrong quite a bit. And especially after COVID, when India's come out of the shock beautifully in terms of economic growth, and China is still struggling. There's still a lot of pressures, and there's still a lot of policy initiatives being announced there to revive the economy even 4 or 5 years down post-COVID. Because of several other issues as well. But India overall has been one of the star performers when it comes to economic growth. We've consistently over the last few years surpassed a lot of global economies in terms of sheer scale and size of the economy. The absolute number of the GDP, and we are set to become the third largest economy soon. This also, it becomes important to lay out a context in that as well, which is the last 2-3 years where the world economy was suffering pretty much in a very uniform manner, because most of the world was grappling with high inflation, and high inflation usually results in high interest rates as well, because monetary policy has to be very aggressive, very contractionary to tackle inflation. So the whole idea is that when inflation is rising, you slow the economy down in order to curb inflation. And that was a problem that the world together faced in 21-22 because of issues that were more global in nature. So you saw the steepest and fastest interest rate hike for multiple economies at the same time, including for India. And despite that, India turned out to be one of the fastest growing economies, which put it in a very special spot at a global stage, making it the preferred investment destination. So the government was able to do a brilliant job at that point in time, using fiscal support in order to make up for what was lacking on the monetary front. So setting the stage here, India, great place over the last 10 years. And will this continue? Right, that's where plot setting becomes a little important. We feel that if you look around at this point in time, and you try to think about this, that where will India be in the next 5 years or 10 years? Do you think it'll be in a place which is neutral from where it is right now, or do you think it'll be better from here? And I think the unanimous answer would be that it'd be better. And let's not just rely on guesses or what we see around or observation or stuff like that. There is hard data or legitimate tailwinds in place already that give us enough confidence in saying that this story will play out and India will continue being the fastest growing economy for several years. 3-4 major factors that play a role in this. Number one, that India's got the demographic dividend. It's got the youngest population, very commonly put, more the working population, more the economic output, higher the growth, right? And if you compare that with other economies, China is in a place where they're actually facing a aging population. On the other hand, you've got Japan, which is already an old population. So India is much better placed compared to a lot of economies across the globe when it comes to our average age of the population and how much working population we have. The other thing is political stability. We're going to talk purely from a financial and economic standpoint. We're not going to touch the social aspects of political stability here, and looking only at that dimension because we only care about the money here, is that the government has been great and political stability in India has been rising. It's not only because of this government, it might have, the graph shows that it's accelerated after the current government has come in, but political stability in India has been rising quite consistently. And we can see that in terms of how unanimously decision making is happening, how much top-down support there is in terms of policy, not just formation, but also implementation and execution. And that's where this is also reflecting very heavily in economic growth. And if you kind of have to look at a live example of how this worked out, I want to go back to the time when we were talking about inflation and how monetary policy was curbing growth at that point in time, but it was India which was very aggressively pushing on the fiscal side, spending a lot of money, not caring about deficits too much, and actually spurring growth. So India was able to pull off that magnificent growth only because of the amount of fiscal expenditure and aggression that the government showed. And that reflects not only in the stability, but also comes to the next point, which is despite that growth, our fiscal deficit was pretty much in check. Okay, it wasn't pretty much in check, it was still reducing after COVID. The government did what was necessary in order to spur growth, but now that that necessity is out, we're seeing fiscal deficit and reduction and fiscal prudence to be a key topic and key priority for the government. Look at the last two budgets. There is a clear priority in terms of saying that fiscal deficit control is important and that prudence is important and that borrowings need to be kept in check. All these things and some other factors pretty much place India up there when it comes to the long-term tailwinds to drive growth in the future as well. So if you look at the next 10-20 years, are you confident that India will grow as an economy? Yes. And as far as we are concerned about the markets, I think India again becomes a hero here because there are multiple markets available, right, on an emerging front, which are growing fast, which have demographic dividend, which have political stability. However, I want to point out that India is one of those very few places which has the depth as well as the breadth, and that too increasingly. Just look at this example of the number of stocks with a market cap of more than $5 billion. India stands fourth in the world on this metric. We've got a rich listing of about more than 4,000 companies. A lot of them are above the $5 billion mark. There are several, in fact, if you look at the market cap of Reliance, there'll be several smaller economies where the entire market cap of the country is that much. So India has got the depth clearly. It's got the breadth as well, which not only in terms of number of companies, but also in terms of the number of sectors these companies are in, the type of businesses, the type of industries, what products they make. There's a wide variety of investment choices available in India. And there's also openness from the government in terms of opening the economy up to foreign investments, encouraging it, although we're seeing the opposite. But if you look at the larger picture, what you'll notice is that India's share in the MSCI Emerging Market Index has now beaten that of China, and that is a big deal. The MSCI index, just for context for retail investors, is important, and that's important because global funds, when they invest across the globe, what they do is there is a benchmarking, right? Like we have the Nifty 50 for India. So the world index, or at an emerging level, the index used is usually MSCI. So what a global fund investing in emerging markets will do is, for example, say that India, the MSCI weightage is about 21 point whatever percentage. China is at 22 or whatever. If it's at 21%, if somebody is overweight Indian markets, they will take an exposure which is larger than 21% in the Indian markets. Effectively, the fund manager's goal is to beat the underlying benchmark. If they have to beat the benchmark, they have to take bold calls in terms of being overweight or underweight economies altogether, right? So any global fund who's looking to make alpha, who thinks the Indian markets will perform well, will typically be overweight India. Earlier, they would have to probably allocate 6 or 8% of their fund to India to be overweight. Today, they have to allocate about 23-25% of their overall funds to India in order to be overweight. So, the overall weightage of India increasing in the MSCI index, whether it is the world index or emerging markets index, is extremely important because that determines how much money in absolute terms comes to India. And that's why there is a huge inflow or outflow that is usually seen when it comes to MSCI rebalances. So the heroes here, we've got breadth, we've got depth, we've got long-term tailwinds, and we're the fastest growing. So obviously there is a problem because this does not add up to the correction of 12% that we've seen in the markets, is what you can say theoretically. However, any given direction is not going to be very uniform. So if you think the Indian markets are going to go up over the next 10 years, sure, can do, believable. But are they going to go up consistently every single day, every single month, every single year? No, that's not going to happen. You're not going to see a straight line increase. It's always going to be one which is filled with peaks and troughs. However, the overall direction is going to be up. Right? So we got to understand where we are headed on a structural basis. And as long as you know that from a structural standpoint, you're headed in the right direction, these short-term aberrations should not really worry you. Unless you're saying that the structural direction itself is hampered or has changed or is questionable at this point in time. Now, whatever the reasons for the current slowdown are, let me just highlight those to you a little bit and tell you how these do not really seem structural in the next slide. So, number one problem, GDP growth has been contracting. If you look at post-COVID, GDP growth has been strong. It was increasing. It was rising also because the government was spending mad amounts of money on infrastructure development, capex, defense. It was spending, right? The more the government spends, the more orders come in, the more factory output there is, the more jobs that are created. The economy is bursting because of this spending, right? Money is being spent, stuff is being bought, the economy is growing. And that was necessary because monetary policy was contractionary. Then what happened is, last year, the government said, hey, fiscal deficit needs to be under check, spending has to come down. Additionally, the economy doesn't really require that spending anymore. That's another reason why the spending came down in the first place. Mind you, this was not a decline in spending. This was a decline in growth rate. So rather than capex growing by 30-40%, it started growing by 10 or 12%. Still a high number, but there's just a reduction in growth rate and not a reduction in absolute amounts. I think that is an important point to cover at this point. Number two, we've also got a trickle-down effect on corporate earnings. because the GDP itself started coming off in terms of growth. You've also seen corporate earnings being a little dismal over the last 3 to 4 quarters. Profit growth has been lower compared to what was in the previous year before that, and management commentary has been indicating that now things seem to have bottomed out. So probably March quarter onwards, they're expecting some amount of stability, most corporates, or at least, if not growth, some stability. Right, so one more factor down there. And the last thing that's affected the Indian markets is liquidity. We've seen a consistent selling by FIIs since post-COVID. The markets must have risen all this while MSCI indices have given a higher weightage to India. But if you look at FIIs, they have been consistently selling the Indian markets over the last 4-5 years now. This selling has been very, very aggressive, especially in 2025, when within the first couple of months, we've come to selling that has surpassed about 5 months of selling in the previous year. So very aggressive selling, left, right, center. There is just exits, primarily also because of the rupee depreciation, also because how the US economy is performing much better. Several other factors there, but that's for some other time. The point is that there are several headwinds for the Indian markets at this point in time, and that's what's affected markets and resulted in the downfall that we've seen in the past. Now, why do we say that this is temporary? We've got a few reasons, right? One of them is that many people called this budget out to be a poor one because fiscal aggression was down. Whoever is accustomed to the last 5 to 7 years of fiscal growth and fiscal push suddenly saw that this is not there anymore. But that is not the only tool that an economy has in order to grow. You've got fiscal policy and monetary policy. Remember that monetary policy was not supportive. This rate cut that we've seen recently is the first rate cut in 5 years for the Indian economy. So the context and underlying situation is very, very different at this point in time compared to what it was. So was the budget insufficient? No, it was not. Was it insufficient in terms of capex spend? Sure. Was it overall insufficient? No. Because what was lacking in capex was made up for in the kind of tax foregoing the government took upon itself by revising the income tax structures, which everybody was pleased about. From an economic standpoint, the simple math is that if your tax foregone or revenue foregone through taxes is about 1 lakh crore, that is the 1 lakh crore that is available in the economy for people, consumers to spend. Right, so there is an immediate money availability in the hands of the end consumer to spend. Agreed that capex usually has long-term benefits and a multiplier effect, but this is money directly available in the hands of the people, which is going to the economy faster. So if we have to look at how much tax benefits the government has provided in the past, combine that with the capex number at an absolute level, we would be pumping in about 2 lakh crore into the market from the fiscal side in FY26, which is almost 3x of what was in FY25, right? And which is comparable to the median that we've seen in the 3 years before that. So if we were happy about the budgets before that in the last 3 years, I think there is enough reason for us to be happy about the current budget as well. So there is enough going on in terms of fiscal policy. Inflation has been coming off, and you've seen RBI's first rate cut recently. In addition to the rate cut, the RBI has been pumping money into the economy to support the banking sector and the liquidity requirement as well. Put together, fiscal policy and monetary policy, both being expansionary at the same time, is going to do wonders for the economy. When one is expansionary, one is contractionary, there is a negating or neutralizing effect. When both are expansionary, it is extremely positive. Right, so we are in that stage. Third thing is that valuations for India were very expensive. That is a very common argument you see because valuation premium is so high. India trades at 22 times compared to much cheaper economies outside. So if you're getting similar growth rate in China for it trading in the lower teens, why will you not opt for that? Good argument. If you're getting the US economy, which is a developed country showing extreme robustness at a similar valuation, why not, right? Because the risk in an emerging economy is larger. Again, coming back to just one point here, what is the visibility that India has to offer? What is the visibility that this hero has to offer here? This hero has got the long-term tailwinds for the next decade or two, right? So if you've got that kind of visibility, usually valuation premiums do not really are not really questioned. There are two things that are the reason for high valuations or premium valuations. Number one is higher growth or growth premium. Number two is visibility of that growth coming in. I think we had a blip on the growth because of election, because of several other factors, because of a priority shift, because of several other factors, right, confluencing at the same time. However, if that is going to change, if you're going to again see a rebound in growth with visibility, there is no reason for India to start trading at that premium again. So you've lost about 15% premium in the market. Cool. That can come back, right? So point being that long-term tailwinds are in place, and we see a lot of the factors played out over the last 2-3 months to have contributed positively and to the India story. So if at all the India story, yes, it had weakened, no one's denying that, but if at all over the last 2-3 months you had to assess it, it's only gotten stronger and the markets have gotten weaker. So this, according to us, is a very, very good opportunity in order to invest money. Fundamentally, are you in the right place? Yes. Are earnings going to rebound? That's what it looks like. Is there visibility of earnings being good for the next many years? Yes. Is the market conducive enough, or is it welcoming enough for investments? Yes. That just sets you perfectly for the long term. If you have to assess the last 5 years, the GDP growth was about 7%, Nifty 500's return was about 20%. If you're confident that forget acceleration in growth, even if Indian economy continues to grow at 7% for the next 5 years, corporate earnings will be at least 1.5 times of that GDP growth. Right? If you invest in companies that are even better or high quality or correctly placed, you can achieve even higher than that. Right? And that's what translates into returns at the end of the day. So over the next 5 years, if you're sure that 7% growth can come in, you invest in the equity markets and you pick out good stocks, you can make a lot of money. There may be limited room for valuation re-rating from here because a lot of the valuation re-rating has already happened in the last 3 years. That's why our view or strategy for this market is that at the end of the day, the unprecedented rally that you've seen over the last 3 years may not happen in the next few years. Right? Valuation catch-up has happened to a large extent. So everything hinges on to earnings growth. In that case, what will happen is that you'll have to be extremely selective in terms of stock selection. You can't just pick out anything in the market and that will work. Those days are gone. Those lucky days are gone. If you've made your money that way, great for you, but it's time to change strategies. And this cusp of bad times stabilizing and probably turning into good times is a good time to also reassess how you're playing the markets and reassess your strategy. So one of the things that we have been at least implementing in our fund management across products and companies is that we are being extremely selective and picky in terms of what stocks we're picking. So we're picking out stocks that are very high quality businesses, that have great management teams and leaderships, that have very high corporate governance standards, that have extremely prudent and efficient capital allocation, and at the same time offer you long-term tailwinds for earnings growth and high visibility of earnings growth, and come at a cheap price as well. So the list was long, got me breathless, but obviously that stringent criteria is required, that prudence is required, and that is a strategy we are not just applying for ourselves but also advising our clients to apply. Don't pick up anything. This is a good time to clean up mess. In fact, pick up stocks that are great and rejig your portfolios, because this fall offers you an opportunity that will make you a lot of wealth if your vision is set over the long term. So let this hero make you money while it becomes victorious. With that, closing this week's storytelling. Next time we'll come back with a stock story or a narrative which has either generated wealth for us in the past or we think can generate wealth in the future. Up until then, thank you very much for watching. See you next time.